Hey there, welcome to Investing Path, your go-to channel for all the things about finance. Today, we've got some breaking news that sets to shake up the financial world. The Federal Reserve has just made a major announcement that could have significant impact on our investments. So, get ready to dive into the details. With the Fed's 10th rate hike now in effect, the landscape is changing rapidly. We're here to bring you all the important updates you need to know. The repercussions of higher interest rates are already putting immense pressure on banks, pushing some to the brink of failure. Furthermore, the housing market is predicted to witness a 10% year-over-year decline, while experts are sounding the alarm that the stock market could potentially plunge by a staggering 60% if the Fed doesn't act swiftly. If you're eager to learn what the Federal Reserve just disclosed and why it could lead to another market frenzy, you've come to the right place. In this video, we will delve into the specifics of their latest announcement, their warnings for the economy, and what they predict will unfold over the next 12 months. Brace yourself, because this will directly impact you and your hard-earned money. Alright, so before we delve into the Federal Reserve's plan for the remainder of the year, it is crucial that we address some of the irreversible damage that has already occurred. Firstly, let's talk about the banking crisis. It is no surprise that over the past few months, four major banks, Silvergate, Signature, Silicon Valley, and most recently, First Republic, have experienced failures. These institutions have suffered significant losses on their balance sheets due to the impact of higher interest rates. Now, as for assigning blame, it really depends on your perspective. On one hand, banks argue that the Fed raised interest rates at an irresponsible pace. Even today, banks are grappling with over $600 billion in unrealized losses, primarily because we've witnessed the swiftest rate hikes in history. On the other hand, the Federal Reserve contends that poor management and the holding of substantial loans made banks vulnerable. Fortunately, other banks have stepped in to prevent a complete panic. Moving on, we encounter a second issue: the national debt. Consider this. Currently, the United States must pay interest on the approximately $31.4 trillion it has borrowed to sustain our economy. Previously, when interest rates were close to zero, paying off the interest was relatively straightforward because for the most part, it was virtually cost-free. However, with rates now at their highest since 2004, these interest payments are projected to reach record levels and are expected to climb even higher over the next decade. Consequently, alternative methods of payment will need to be explored. Lastly, the third concern arises due to the increased cost of debt, leaving consumers with less money available for savings. For instance, according to a recent report by BlackRock, the personal savings rate took a significant hit in 2022. When disposable income decreases, it inevitably impacts our next topic, the housing market. Now, when it comes to the reasons behind this and whether there will be any changes in the near future, we turn to Redfin, a reliable source that compiles a monthly report on the entire housing market. This latest report is truly fascinating, or at least we find it intriguing since we have a peculiar fascination with these things. On a broader scale, according to Redfin, new listings have decreased by over 20% compared to last year, as homeowners are holding on to low mortgage rates. As a result, buyers are swiftly snatching up homes, preventing prices from dropping further. Moreover, due to the scarcity of sellers, homes on the market are selling slightly faster than anticipated, with nearly half of them selling within 2 weeks, the highest percentage in almost a year. Certainly, it is true that prices are experiencing a decline, with national values down by 2.8%, and certain areas like Austin, Texas, seeing a drop as significant as 13.7%. However, overall, there are still more individuals looking to purchase a home than there are sellers, which is helping to maintain stable prices. For many people, it simply doesn't make sense to sell right now, even if housing values continue to decrease. Additionally, buyer activity is heating up as we enter the bustling spring and summer seasons for real estate. Touring activity has increased by 28% compared to the beginning of the year, surpassing the 17% increase during the same period last year. Furthermore, as you can observe, new listings are at their lowest point since 2020, providing yet another lifeline for the housing market to stay afloat. So, to present a comprehensive perspective, Let us consider both the bulls and the bears. On one side, we have hedge fund manager John Husman, who has reportedly predicted both the stock market crashes of 2000 and 2008. According to him, our current equity market valuations remain more extreme than any other point in history, with the exception of a few months around 1929 peak and a 2-week period in April 1930. Consequently, he anticipates negative 10 to 12-year S&P 500 total returns with the potential for interim losses as high as 60%. However, on the positive side, we have strong stock market earnings, a job market that remains near its lowest unemployment rate in 54 years, and Bank of America believes that we could witness a 16% increase in the S&P 500 over the next 12 months. Our reasoning is based on relatively bearish sell-side consensus indicator at the moment. Historically, when this indicator is low, the stock market tends to move in the opposite direction. Additionally, investors currently seem to prefer bonds and treasuries over stocks, suggesting that there may be significant potential investment capital waiting to enter the market when conditions reverse. Now, let us talk about the recent developments and the new changes taking effect. The Federal Reserve has decided to raise interest rates by an additional 25 basis points, bringing us closer to what is referred to as the terminal federal funds rate. This rate represents the highest interest rate they expect to reach before eventually decreasing. As of today, we have reached that rate, which ranges between 5 and 5.25%. One significant update is that they have removed language from the report regarding determining the extent of future increases in the target range. Essentially, this implies that they are currently finished with rate hikes and will adopt a wait-and-see approach to assess the need for any future increases. This is a major development. They have successfully achieved their target, and if inflation starts to recede, they may maintain this rate for a while longer to assess the effectiveness of their strategy. If it proves successful, that's a great news. However, if it doesn't yield the desired results, we may see future rate hikes toward the end of the year, but that remains uncertain. The Federal Reserve has also openly acknowledged the presence of tighter credit conditions, resulting in fewer loans being granted and lower loan amounts. This aligns with their planned strategy and has had an impact on the economy. Overall, this report and Powell's speech suggest that everything is progressing according to their intentions. They have taken all the necessary steps for now, and the outcome now relies on the economic data we will observe over the next few months. Beyond that, in terms of the rest of the economy, we believe that the most significant impact we are likely to witness will be in the form of reduced lending, stricter policies, and potential failures. However, in the grand scheme of things, it may not have a substantial overall impact. Furthermore, some economies are starting to argue that growth is resuming and wage increases are outpacing price changes in the recent months, suggesting that the consumers may regain some disposable income. Certainly, this situation could potentially challenge the Federal Reserve's plan to curb and reduce inflation. On the positive side, increased income could contribute to a soft landing that keeps our economy functioning without encountering a significant turbulence. Therefore, our primary immediate concern revolves around a potential credit crunch, with banks lending less money to fewer individuals and higher interest rates making it harder for the average person to obtain a loan. Regarding our perspective on these matters, as usual, we believe the latest information does not provide substantial new insights. The Federal Reserve remains committed to addressing inflation on a month-to-month basis, ready to adapt and maintain higher rates if inflation persists. Our next inflation report is scheduled for May 10th, and it is expected to either continue on a downward trajectory or remain stable. Given the increased consumer spending, the next few months will likely provide us with more valuable insights into the effectiveness of their plan. That is why we personally adopt a conservative approach by diversifying our investments, keeping some cash available for potential real estate opportunities, and utilizing dollar cost averaging with a diverse selection of index funds that we intend to hold for the long term. Although it may seem unexciting and unsophisticated, historical evidence repeatedly demonstrates that even experts like Michael Burry cannot accurately predict market outcomes. And that wraps up our discussion on the latest developments in the economy and the potential impacts on your investments. We hope you found this video informative and insightful. Now, we'd love to hear from you. What are your thoughts on the current economic situation and its implications for the future? Do you agree or disagree with the experts' perspectives we discussed? Remember, here at Investing Path, we are dedicated to helping you navigate the world of investing and make informed decisions. If you found this video valuable, be sure to give a thumbs up and subscribe to our channel for more insightful content on personal finance, investment strategies, and market updates. And if you have any specific topics or questions you'd like us to cover in the future videos, please let us know in the comments below. Thank you for joining us on the Investing Path, where we guide you towards a prosperous financial future. Keep learning, keep investing, and we'll see you in the next video.